All right, time to talk about estimated and contingent liabilities and ethics. This is a little bit about how those liabilities go together with ethics coming your way. So take your best guess, but be careful what you tell them is all about lawsuits, which we're going to talk about here in a sec. So having a look at this stuff, just moving along here. Let me just try and advance this. Next slide. There we go. So we talked about current liabilities that are known, where you can figure out what the amount is, but sometimes you have liabilities that you don't know the amount that you're going to pay out. Sometimes it's just a little fuzzier as to how much you're actually going to pay out for that sale or for some sort of transaction that happened, say, in this past year. So example of those things might be warranties. And we'll go through that to begin with, then go on to vacation pay and corporate tax. But all good examples of when you've got to estimate current liabilities, just so you have proper matching of your revenue and expenses. But here we have an example in warranties where we might have some sort of idea of what we normally have to pay out for warranty claims. I can buy a new truck today, and maybe I spend $50,000 on that truck, but I'll go back to the dealer, say during the next year or two or three, whatever it is. I might go back and say, oh, you know what, all this particular thing is not working anymore, and it's covered under warranty. Please fix it. In which case, the dealership asks the manufacturer. So if I bought a Ford truck, then from a Ford dealer, the Ford dealer asks the Ford manufacturing company to be reimbursed for whatever it costs to fix that warranty item. And we don't know what the warranties are going to be on every particular truck or trailer or computer. We have no idea on those sort of things. But we can narrow it down as to what it's going to be. And we can do that based on our previous experience. Apple might know that 5% of their MacBooks are going to crater on them, and they'll have to spend $100 or $1,000 on each one in order to fix that. So they take that previous experience, the experience within the industry, and they determine how much should be set up as a warranty. Oftentimes I see that as a percentage of the sale amount. So for example, on a MacBook, if we paid $3,000 for a MacBook, and and Apple's experience is that they're going to spend all $300 on every MacBook to cover warranty costs. That's 10%. Then we need to set up 10% of the sales cost as a warranty expense. And as we pay down that, as Apple pays out those warranty costs, it reduces the liability that it's set up. But it'll set up more warranties for new products that it happens to create. So it's a moving target. They use their experience, their industry knowledge, really to figure out what the warranty should be, and away they go from there. Now, vacation pay is another example. We don't know when the employee is going to take their vacation, and we don't even know what their rate of pay is going to be perhaps at that point in time. So sometimes we'll have salaried employees, for example, that get 2 weeks worth of holiday in a year, or 3 weeks worth of holiday, whatever it is, and they don't know what sort of rate they're going to be paid, because their rate changes during the year as they are promoted or do whatever. So those 3 weeks, if they're paid out in December, might be at a higher rate, say, than they were if they're paid out in January. So we don't know for sure, but we estimate based on our experience, what we normally see those vacation pays paid out. Everybody loves to go on a summer holiday, maybe that sort of thing. But based on our best experience, we accrue those expenses and those payables. Another one's corporate income tax. And corporate income tax is is a little better known, but still not always known. We know that there's some tax that we're going to pay at some point on whatever the profits are in a company, but we don't know if the rate today will be the same date, say 6 months from now. Maybe there's a new federal or provincial budget, and it changes the corporate tax, that rate. It goes up or down or something like that. Well, we always make our best guess based on what we've seen. So we know what the tax rate is today. We can use that if we like. If we know that that there's been a challenge here and we've had lots and lots of costs related to COVID that have showed up, then how are we going to pay for that? Well, the only way that the government pays for that is increasing taxes. So maybe we anticipate higher corporate taxes moving ahead. I don't know. We'll have to see what happens for sure. So then we get into contingent liabilities. These are different. These are liabilities where we again have some sort of liability based on a past transaction, but we're going to pay for it in the future. And lawsuits are the perfect example of that. Lawsuits arise because of something that happened in the past, but we won't actually settle that lawsuit or eliminate that lawsuit until somewhere down the road. So we have to look at those lawsuits and say, does this make sense that we are going to disclose this first of all? Like, is it likely that we're going to have a loss? And if it's likely, then we need to have some sort of disclosure related to that. And if there is going to be a loss, we need to know whether or not the loss can be estimated and if it will be a big enough number. Because if it's a lawsuit for $1,000 and we're a multi-million-dollar company, well, it probably isn't significant. We probably don't need to worry about it. But perhaps it's a big lawsuit. Maybe it's an environmental lawsuit where we've created a huge problem, and now we're in a position where we've got some sort of huge potential claim against us. Maybe it'll wipe out the company. Who knows? Well, we have to go through those particular instances and determine whether or not there's a likeliness of loss and whether or not the loss can be estimated and if it'll be significant. And have a look at Exhibit 11-4 in the text. It gives you some really good direction on when you need to record it or not. So then just moving along, the ethics around liabilities and whether or not we disclose liabilities, it has an impact. Whether it's a regular liability that you've estimated or you know what it is, or if it's a contingent liability that we're not sure what it is for a while, it will impact the bottom line. It'll impact profitability. An employee who gets paid based on business profitability would be reluctant to record a liability because that would show less profitability and would minimize their bonus. So liabilities are a challenge sometimes because the people who help to determine what they are sometimes don't want you to record them, but ethically they've got a responsibility to record them. And on a lawsuit and some contingent liabilities, sometimes you can get yourself in trouble here and you don't even mean to. Disclosing the amount of a contingent liability, what it might be, might disclose to the other side, to the opposing counsel, as to how much they think they can get from you out of this. So with public companies, these particular contingent liabilities are a real challenge. If they don't want to they don't want to mislead their financial statement readers and say, oh, you know what, we have this claim, but don't worry about it. No, if it's significant, they have to disclose it. The problem is if it's a public company statement and the opposing counsel has access to that, well, they know how much you've already set up as a liability or how much you think you're going to lose. Gives them a leg up in some of the negotiating that might go on. So there you go. That's some of the ethical challenges from liabilities. Hope you enjoyed this section.